Happy Friday, everybody. November 14th, Scott Riley, the Market Update Desk, NMLS number 157524. Well, in sports, we have the evil empire is back, everybody. New England Patriots go to 9-2, beating the Jets last night. I'm a Brady fan, so having the Patriots back is a fun thing for me. Let's talk about what's going on in market news. We had the one and only Diana Olick from CNBC once again open her mouth and look silly. Now, she's been beaten up on the housing market for, gosh, probably 5-6 years now. If you listen to her, you would have lost tens, if not hundreds of thousands of dollars in equity by not buying. She's been wrong at just about every stage of the market. To give you an idea, over the last 5 years, home prices have risen by 60%. But she keeps saying how the housing market is going to continue to go down. So her latest headline was newsflash: new foreclosures jump 20% in October, a sign of more distress in the housing market. Wow, that's a scary headline, isn't it? Let's go into what she buried deep within the report. So the problem was that many are going to read just the headline and be afraid to purchase a home. Later in the article, buried within it, she explains that, oh, wow, that this is an increase off of extremely low levels, and the overall level of foreclosures are still very low. She mentioned it's less than half to 1/3 of the level of normal foreclosures. So she buries that, lives on the headline, tries to get clicks. Now, let's talk about Fed members as we get ready 26 days from now for the December 10th next Fed meeting. Now, there have been several Fed members who have spoken out this last week expressing their views regarding a cut in December. We've got Boston Fed President and voting member Collins. She's not in favor of a cut as she thinks inflation is too high. And she's not, underscored, not worried about the labor market, even when those signs are as clear as glass when we see them through the data. There's clear signs of job deterioration. So why she says that is anybody's best guess. Kansas City Fed President and voting member Schmidt is also against a cut as he dissented in the October 29th meeting. St. Louis Fed President voting member Muslium believes that inflation is still too high and not overly concerned with the labor market. He believes unemployment will rise from 4.3 to 4.5, but thinks that's still close enough to maximum employment that he doesn't see a reason to cut and doesn't have many concerns for the job market. Very odd statements here. There were also some non-voting Fed members who spoke. Fed member, non-voting member, Bostic from the Dallas Fed, and Lori Logan of the Cleveland Fed, and Beth Hammock. All three were not in favor of Fed cut last time, and they may not be in favor of a Fed cut this time. Minneapolis Fed President Kashkari's on the fence. He was against a cut in October, but could go either way. So what that boils down to, the odds of a December 10th cut were up to 95% before Chairman Powell spoke after the last meeting. Came out much more hawkish than what the markets expected. And now that is basically turned to a coin toss of only a 49% chance of a rate cut. Now, most of the important data are going to be housed within the jobs data. And it seems like every week we hear new large companies announcing layoffs. Just yesterday, Verizon announced they were going to cut 15% of their workforce, which equates to just near 15,000 workers. Now we look at the chart shared, we look at different charts, showed the average ADP job creation over the last 3 months was 3,333 jobs. Shows that it's weak as opposed to what the Fed members are saying. So the NEC Director, Kevin Hassett, spoke yesterday and said it's likely the September jobs report will be released next week. It's not written in stone. We'll wait to see that. And the October jobs report, when it's released, will only be the business survey, not the headline report. So we're starting to get an idea of when those reports are going to come. May not have all the details that the market's really looking for. As we look at the charts this morning, 10-year is down 4.1 up to 4.14. That's a very important resistance line. If we go above that, we've got some room to the upside, which would be bad for mortgage rates. We're seeing the NASDAQ, which has been in the red the last couple of days, as opposed to the Dow, starting to claw back some of its losses, specifically within the tech and semiconductor sectors. So we're working all weekend. We've been very busy this week helping borrowers. Got a couple deals accepted, working on a couple new refis. Give us a call. We'll help break down the numbers, see what could work for you, and help you out. Give us a call, 616-293-2189, the Market Update Desk, your original singular market news source for West Michigan. Have a great weekend, everybody.